Hey, personal finance gang, we're going to finish up the discussion on bonds. And here, I thought I'd show you something real quick before we get to bonds. This is my work in progress. Here you go, see if you can see that. That's my little hydroponics area. It's actually, I'm growing, the big one there is basil, and those are other boxes, 7 of the boxes. You're supposed to have these going all the time, but I had let my guard down, hadn't had stuff growing lately, but that's lettuce in the other 7 boxes coming up. All you do is add water and nutrients to each of those boxes. They're just $5 boxes from Home Depot. Drill the holes in there, and I've got these little basket things and some, I forget what the stuff is called in there. Put the seeds in, and lettuce grows, and no maintenance until you start clipping lettuce. But anyway, and they're just right now under LED bulbs that come on automatically every day for about 14 hours. Anyway, so let's get back to bonds, though. That was just a side on hydroponics and food. But so we're talking about categories of bonds, and last time, I'm going to back up, I went the wrong way, but we were talking about categories of bonds, and we categorize bonds. One of the ways we do that is by the type. So we saw treasury bonds and agency bonds. So treasury bonds issued by the U.S. government, agency bonds by places like the post office, Fannie Mae, Freddie Mac, student loan organization, and all state and local government bonds. And now we're going to talk just briefly about corporate bonds. And back to where we are. So corporate bonds, many of these as a group, they're riskier than the other categories. So they have more of what we call default risk, a higher probability that they won't be able to pay, or pay their interest on time or in full, or the amount they owe, etc. So you do need to check into the risk of corporate bonds before you buy them. And most bonds are not very liquid. Most corporate bonds are, in fact, highly illiquid. Means there's not much of a ready market for them. There's not active trading going on in them. There may be big, long gaps of weeks or months between trading in some securities, these and municipal bonds. And the big holders of corporate bonds are life insurance and pension funds. But there are a lot of investors buy these through mutual funds and ETFs as well. But now so that was all we're going to say on corporate bonds. It's just company needs to borrow money. So again, remember, if you buy a corporate bond, you are lending money. Now, you're going to have rules. Bondholders don't want to just, hey, lend some money and, hey, do whatever you want with the company. There are restrictive covenants telling companies things they can do and things they can't do. So among the things that companies must do, and there are things they must do as well. So among the things they must do is have audited financial statements typically, and they must maintain certain accounting ratios. You can't take the money and go gambling, for example, with it. So there are certain restricted uses on the funds as well. But that's, just so the company can't take advantage of the bondholders. Now, some things you need to know about bonds, and so these are good hint terms for a test and such. A bond that you buy is going to have a coupon payment and a coupon rate. And coupon payment is just what we call the interest payments. So you get a coupon payment or interest payment from owning the bond. Reason it's called a coupon payment is it's a historical holdover. In the old days, and I actually have seen some of these, but they were already disappearing when I came around into finance. But there were bonds where they were printed on big sheets of paper, and they had little dash things, and you get out your scissors and clip out a coupon that said, oh, here's this bond owes a $20 payment, and your bond info number and all, and then you'd carry that clipped out coupon to the bank, and they'd send it off, and the issuer would send you a check. So that's why it's called a coupon payment, because you literally used to have to clip it out. But anyway, the coupon rate, we'll see that again coming up, but that's just the percentage rate. It's that coupon payment divided by the face value of your bond. And the face value is just how much the company or issuer of the bond has promised to pay at maturity. That face value is also called maturity value because, hey, that's what you're going to get when the bond matures. Also called the bond's principal amount. Anyway, so different terms for what you're going to collect when the bond matures, in addition to a final coupon payment. The maturity date is just when is that final payment going to be made. Now, none of these things change over the life of the bond. These are all written in ink. They do not change. So the amount that's owed at maturity doesn't change. The maturity date doesn't change. The coupon payment and the coupon rate don't change. What does change, though, is how much people are willing to pay for this bond. Now, there are several risks associated with owning a bond. We're only going to touch on 3 of them. So we'll see interest rate risk, purchasing power or inflation risk, and default or credit risk. Now, a key concept associated with bonds has to do with interest rates, and this is called interest rate risk. If you own a bond and interest rates go down, your bond is suddenly worth more. Your bond price will go up. Reason for that, you have a bond that's promising to pay, let's say you have a bond that's promising to pay 3%, and right now the market interest rate is 3%. If the going rate on bonds similar to yours drops to 2%, well, you've got a bond paying 3%. Your bond is suddenly worth more, because remember, those coupon payments don't change. So if interest rates drop, bond prices go down. The opposite is also true. So you've got a bond that's paying 3%, and interest rates for similar bonds go up to 4%. Well, your bond's only paying 3%. So what are you going to do to sell that bond? You're going to have to cut the price. So if interest rates go up, bond prices go down. So again, bond prices and interest rates inversely related. Now, so that's one key bond concept. The next one has to do with time. So we know if interest rates go up, bond prices go down, but which would go down more, the price of a long-term bond or the price of a short-term bond? Well, this is a key concept here. Long-term bonds are a lot more volatile than short-term bonds. So if interest rates go up, the price of long-term bonds will go down a lot more than the prices of short-term bonds. In my investments class, we would grab our calculators and I demonstrate this, but just trust me on this one here. You can see the opposite as well. If interest rates go down, the prices of long-term bonds will go up a lot more than the prices of short-term bonds. It relates to the time value of money. More distant cash flows are more heavily impacted by changes in interest rates than near-term cash flows. So the key takeaway from this, long-term bonds are riskier than short-term bonds. Their prices will change a lot more with changes in interest rates than the prices of short-term bonds. So that's interest rate risk as it relates to long or short-term bonds. The second risk on our topic here is purchasing power risk. We've got this a couple ways with bonds. Bonds are called fixed income bonds or fixed income securities because, well, I mentioned this earlier, the coupon payments that you collect on a bond don't change over the life of a bond. So let's say we have a $1,000 bond that's paying us $50 a year. and we're kind of happy with that $50. $50 sounds good. We can, I don't know, go out and have a really good dinner and a movie for that, maybe. Depends where we're eating and all, I guess. So, and how many of us there are. But anyway, so let's say $50 sounds good. Now we know that over time, if we're going to collect $50 every year, $50 this year is a lot better. We'll be a lot better off with $50 this year than we will be with $50 20 years from now. $50 20 years from now isn't going to buy nearly as much as $50 this year. So over time, inflation will eat away at the value of those cash payments. We know that up front, so we've got that taken into account. But what if inflation is more than we expected? So maybe we were expecting inflation of 2% a year, comparable to what we've had the last several years, and it ends up being 3.5% a year. Well, those future cash flows will be worth even less than we thought they would be. So that's purchasing power risk. Same thing with that $1,000 we collect at maturity. If inflation's more than we thought, it's going to be worth less than we thought as well. Next up, the big risk you think of when you lend anybody money, a corporation, a government, or whatever, is, will they pay me back? Imagine you lend your cousin Lou some money. You're worried about, hey, will Lou pay me back? Will he pay the interest? Will I have to hunt him down and break an arm or leg to get my money back? You have the same concern without the breaking arms or legs. Well, hopefully you won't break Lou's arms or legs either with lending to, say, a corporation. So will they be able to pay you back? The probability that they won't be able to pay you back or pay you back on time is known as default risk. So the higher the default risk, the higher the probability that they won't be able to pay you back, the higher the required return. So imagine that cousin Lou wants to borrow money, and he says, well, I see that the U.S. government's borrowing at 1% right now. I want to borrow at 1%. And you know Lou is very unreliable. You might demand, hey, Lou, sorry, I'm not lending you money unless you pay 10%. So anyway, the higher the risk, the higher the required return. And it's probably better off if you don't lend your relatives money, safer that way. Now, you're going, hey, how do I know how safe these companies are? Well, in fact, most any bond that you're going to want to buy has probably been rated by a rating agency. The companies that are issuing the bonds, the companies selling the bonds where you're buying from, actually pay rating agencies. Sounds like a conflict of interest. It is somewhat, but the rating agencies need to be independent or they lose their credibility. But the companies pay the rating agencies to get their bonds rated to make them more marketable. Okay, so it's going to be hard to sell a bond to someone if they don't have a good idea of the default risk. So they pay, and the rating agencies will rate the debt, and investors will have an idea of how safe these bonds are as far as default risk goes. Now, the two biggest rating agencies are Moody's and Standard & Poor's. Standard & Poor's, remember we saw that with the S&P 500 index. So same company there. But there are a whole big sets of ratings here. Just like you get letter grades for taking your class, there are letter grades for bonds. And the bond rating agencies even do plus-minus ratings. So Moody's, down here starting below AAA, AAA would be the safest rating for both of these. Very, very safe. Very few companies have the highest rating. So like U.S. government debt might be AAA rated, and UPS and Apple and Walmart might have AAA ratings. I haven't looked up who's AAA rated. But so the safest companies would be considered AAA rated. And then we go down here, and there would be Moody's has AA1, AA2, AA3. Standard & Poor's has AA+, AA, AA-, and so forth. Now these top 4 categories here are considered investment grade debt. That means highest quality. So you're expected to get your money back and not lose any sleep over it. Obviously down here on the bottom edge, you're closer to being over here into the speculative grade, where you might start losing a little bit of sleep over whether you're going to collect your money. Well, the top end here, these companies likely have not missed a payment yet, but they're in the area where they may do so. When you get further down in the ratings, we've got companies that have missed payments, and the odds are, the further you get down, the odds are higher that you aren't going to collect even the full value of the face value. Okay. But the lower the rating, the higher the default risk, and the higher the required return on those bonds. Oh, let me jump ahead here. I meant to change this order up here. Now that speculative category, you'll actually hear them referred to in the press as junk bonds. So if you hear junk bonds, that just means these are bonds that are down there in the lower category here. And some financial institutions are prohibited from buying them. And if they get debt that moves into that category, they have to unload it. Now, marketing-wise, if you go to buy these higher risk bonds, why would you buy higher risk bonds? Well, because they pay a higher return, and as long as they don't default, you're happy. But they would be called high yield bonds if you go looking for them. You aren't going to find them advertised as come buy our junk bond portfolio. All right. Now, the 4 categories of bonds, how do they rate as far as risk and return? So the safest category we have here is obviously U.S. Treasuries. Then the riskiest is corporate, and these are kind of in order here, so this wasn't a very exciting ranking thing here. But U.S. Treasury securities have the lowest after-tax returns and the lowest risk. Then we've got agencies that have a little bit more risk, a little bit higher return. Municipals, still a little bit higher risk, a little bit higher return, again after tax. And then we have corporate securities with, on average, the highest risk, highest return. Now, some of these corporate issues are probably safer than a lot of the municipals, but as a whole, the corporate category is the riskiest. Already did that. Now, a few terms related to rates. So we've got 3 different rates that you need to know about associated with bonds. One we already talked about. The coupon rate never changes. This stays the same. It's just the annual coupon payment divided by the face value. So if you have a bond that's going to pay you $50 a year in interest, and it's a $1,000 face value bond, that's a 5% coupon rate. Now, the coupon payment doesn't change, but the current price does. So if the price goes up or down, the current yield will go up or down. We'll actually move in the opposite direction. So if the price goes up, your current yield will go down and vice versa. So current yield is just what are you earning percentage-wise if you buy the bond right now based on its current price? What are you expected to earn percentage-wise over the coming year based on the current price? Now, yield to maturity, we would do this with our calculators if this was a more advanced class, but this is just what do you expect to earn percentage-wise on this bond if you buy it and hold it till it matures. So it's going to be slightly different than these others here, and this is going to have factored into it price changes in the bond as well, more than we need to get into here. Let me just show you a bond quote here. This is for a bond that was issued. The first coupon was back in 2004. It matures. It makes its final payment in 2034, a ways off. There's the coupon rate, 6.55%. The current yield is 5.6%, and the yield to maturity is 5.2 something. Now it shows a price of $116, but you can't actually buy this bond for $116. That's percentage of the face value. So bonds are generally in multiples of 1,000. And there we have, oh, I didn't mention this, the 2 biggest rating agencies are Moody's and Standard & Poor's. The 3rd biggest rating agency is Fitch's. And so there's their rating of this debt at the time here we got it. So they've got an A rating. So remember, we have AAA, AA, A, and then, plus minus on top of that, but this is just right in the middle of the A's. And this is a corporate bond. And, well, it's not callable, and we haven't talked about what that is. You can look that up, but you don't need to worry about it for now or for this class, but it has nothing to do with a phone. And, well, this again was just a quick look at bonds. So you definitely need to know bonds versus stock, what they are. If you buy a bond, you're lending money. If you buy stock, you're taking on a part ownership interest. You need to know that bond prices and interest rates go in the opposite directions. Long-term bonds are more volatile than short-term bonds. Know those terms associated with bonds: the coupon payment, the face value, and the maturity date. And then know a little bit about those 3 risks that we talked about. All right, gang, be good out there, be safe, and I'll be catching up with you again soon.